Michael Burry predicts 7% bond yield is coming. Stock market will be crushed by the falling bond prices. TLT just crashed below 100 once again. Inflation has peaked, narrative is dead, at least in bond market's point of view. Famous investor Michael Burry says terrible consequences are in store if student loans are forgiven. Because a student loan is a form of debt, which is credit or money. If student debt is forgiven, that means a lot of stimulus money is released back into the US. We all know that's how we have this inflation problem in the first place. Giving people free money, loans, credit, whatever you want to call it. How about they start forgiving everyone's mortgages? Then everyone will have free houses. Let's not forget that the student debt problem is built on a foundation of terrible major choices. Why bailing generations out of those bad choices will mean more bad choices. Tuition hikes and terrible consequences for America. What kind of problems? Let's just talk about it. Why it will cause 7% interest rate or bond yield and crash the stock market. Why the stock price will fall down and make new lows. I will explain it all right after this. And of course, smash the like button. If you want to be my good boy, apply to write your first book with me. Welcome back to the Audacious Money Witch channel, where we talk about macroeconomy, stocks, bonds, and commodity markets. If you like any of these topics, you are intelligent. That's why you're here. And you know what to do. And push my button if you like what you see in today's video, because I can't push it from this side. This video is brought to you by my Patreon. If you're a good boy, go to patreon.com/magicalgoddesscheryl to add more meaning into your life. If you play your cards right and completely submit like my good boys do, then I will take you under my wing. Author of best-selling books, Goddess Cheryl. My good boys always get rewarded handsomely. You are such a good boy. You like hearing that, don't you? You want to get into the bookstore. You want it to be real. You want it to be true. You need to be my client, don't you? Burry's comments come as the U.S. Supreme Court considers Tuesday oral arguments over President Biden's student loan forgiveness program, which was legally justified based on the lockdown. The program offered up to $20,000 of loan forgiveness per borrower, an initiative which has been put on hold while the High Court debates the case. We're talking about $500 billion and 43 million Americans. $500 billion can buy Meta plus Twitter. In today's market price of Meta is worth $452 billion plus $44 billion when Elon bought Twitter. Imagine owning both and make them better. The 51-year-old Burry, who rose to fame betting against the housing market before the 2008 crash, took on well into six figures of educational debt, going to UCLA and then Vanderbilt University for his medical degree. He began his residency at Stanford University, but dropped out to focus on investing. That's another $500 billion of stimulus money, ready to be sent out to the 43 million Americans' pockets. While our inflation is still above 6% officially, who knows the real inflation number is at? Interest rate is going higher according to the bond market. Just look at the TLT chart. It broke $100 support. Heading lower again, the trend is still down. Interest rates must be higher than inflation rate to actually cool inflation down. So 7% interest is needed to bring 6% inflation down to 2%. Michael Burry tweeted it last year and said there are second wave of inflation. I think we are experiencing it now. Investors shouldn't bet on the year-to-date bounce in equities to continue as the stock market remains wildly overvalued based on current interest rates. Interest rates have surged over the past year, with the 2-year U.S. Treasury note yielding just over 4.9% as of Thursday morning, compared to just 1.3% a year ago. Such a swift surge in interest rates has put pressure on market valuations, while at the same time exposing vulnerabilities in corporate profits. That's a bad combination for stock prices. History implies that for the current level of real rates, the S&P 500 multiple is around 2.5 times overvalued. Such a steep overvaluation comes at a time when companies will face margin pressure from higher interest rates. Due to higher cost of capital, demand destruction for certain goods, and potential asset write-downs and credit losses, there is a growing risk that investors have returned to complacency when it comes to geopolitical tensions and potential energy market risks. Such complacency could lead to wild price swings if Russia ramps up its offensive against Ukraine, or if tensions between China and the U.S. escalate. The terminal Fed funds rate is now expected to hit about 5.4% later this year, representing another 100 basis point increase from current levels. Furthermore, the Fed could keep rates around that 5.4% level for longer than many are anticipating. That's a market shift from expectations of rate cuts just a few weeks ago, and could keep strong downward pressure on the stock market. It's ultimately a double-edged sword for investors, as solid economic data pushes off a recession, but also pushes off a rate cut from the Fed, because government keeps giving people free money. Hot or warmish prints in the U.S., such as jobs, CPI, retail sales, or services PMI, meant the odds of imminent recession had declined, but at the same time suggested rates must either get more restrictive or stay restrictive for longer. The U.S. stock market continues to be overvalued on several measures, exposing equities to further downside. Stock pickers love bear markets. Suddenly, many companies on their watch list begin to look attractive. But despite the protracted equity market downturn, valuations, almost no matter how you slice or dice them, continue to look rich. It's true the S&P's PE ratio has fallen precipitously over the last 2 years, but that was from nosebleed levels. And now it is only back to its long-term mean. Valuations cannot be said to be unambiguously cheap at an index level. The Nasdaq's PE fell sharply too, but it is only just below its long-term average. Long-term returns are what that matters to most investors. And on that basis, disappointment is likely to await anyone buying stocks. The most popular measure of long-term valuation is the cyclically adjusted PE CAPE ratio. Buying the index when this is historically cheap typically leads to well above average 10-year returns and vice versa. The CAPE has fallen, but still remains in the top 90% of all its readings. This is the same for other measures of long-term value, such as Tobin's Q. The ratio between a firm's market cap and the replacement cost of its assets. And the price to sales ratio, Buffett's favorite measure, the market cap of U.S. equities versus GDP, also remains elevated. Even with the equity market down over 17% from its highs, these measures remain in the top 85 to 90% of all of their readings. This is a market far from screaming buying opportunity of a lifetime. It's hard to make the case that the stock market has bottomed until we see a broad-based and noteworthy decline in PE ratios. And stocks are unlikely to cheapen significantly until they adequately price two major risks: inflation and therefore rates and earnings. We think about how these relate to equity prices by looking at the rule of 20, which states that over the long term, the PE ratio and the inflation rate should sum to 20. When that sum is over 20, the market is said to be overvalued, and undervalued when it is below 20. When inflation is high, as it was in the 1970s, nominal earnings rise, so PEs should adjust lower to take account of this. Today, the rule of 20 implies an S&P 25% lower than its current price. That implied value is destined to fall further as inflation begins to rise again, as it looks set to do, and also as earnings fall. It bears repeating that earnings are a lagging indicator, and they will only begin to decline after the recession, which continues to look odds on even as early as the summer has begun. But until there is a re-rating lower in stocks across the board, it will be tougher to build portfolios of cheap, quality companies that have the potential to post strong, long-term returns. Stock pickers should bide their time for cheaper valuations ahead. Just wait. Those stocks can't go anywhere. Won't go anywhere. Get your list of stocks ready though. If you want to see my list, join my Patreon today. Become my good boy. I will send you my list. And this is my book time. And this is my client's collaboration book. It's already yours, Adversity Equals Success. Such an amazing book with such incredible authors. Order your copy today. You are such a good boy for watching my video right till the end. Bye.